BingX, a trusted global crypto exchange. Trade spot, futures, or copy top traders easily. Sign up via the link or referral code to get 30 USDT instantly, plus up to 1,500 USDT in bonuses for verification, deposit, and trading.
The European Central Bank has maintained its current interest rate stance for the third consecutive meeting, choosing to hold steady despite growing anxieties surrounding inflation within the Eurozone. This decision comes as a modest economic recovery takes root across the 20-member currency bloc, sparking concerns that renewed economic vigor could translate into rising prices. The central bank's key deposit rate remains fixed at 2%, a level that persists even as annual price growth edged up to 2.2% in September. This marks a notable increase from August's 2% and a significant jump from the 1.7% recorded a year prior. Across the broader 27-member European Union, the picture is similar, with annual inflation reaching 2.6% in September, up from 2.4% the previous month. According to the latest Eurostat figures, the ECB's Governing Council, composed of 6 members, has indicated that its assessment of inflation trends is broadly unchanged. The bank points to several pillars of economic resilience, including a robust labor market, healthy private sector balance sheets, and the cumulative effect of past interest rate cuts, as key factors underpinning this stability. Preliminary data released by the European Commission on Thursday paints a picture of an expanding Eurozone economy, which grew by 0.2% in the third quarter compared to the preceding 3 months. This uptick surpassed the expectations of many city analysts, who had forecast a more subdued 0.1% expansion. The engine behind this growth appears to be particularly strong in Spain, which saw a commendable 0.6% increase, alongside a 0.5% rise in France. This rate decision by the ECB arrives at a time of notable divergence in price growth across the individual Eurozone member states, a phenomenon the central bank anticipates will largely stabilize around the 2% mark. While Cyprus has managed to keep inflation at bay, registering a zero rate, other nations have experienced modest increases. France saw inflation at 1.1%, Italy at 1.8%, and Greece also at 1.8%. However, the economic landscape is far from uniform, with Romania reporting a striking inflation rate of 8.6%, compounded by Estonia's 5.3% and Slovakia's 4.6%. The ECB has publicly acknowledged its concern regarding elevated inflation levels, particularly within the services, food, and energy sectors. Nevertheless, over the past 18 months, the bank has progressively lowered its main deposit rate to the current 2% level, a figure that stands in stark contrast to the considerably higher rates of approximately half that in the United Kingdom and the United States. The ECB itself has cautioned that the economic outlook remains shrouded in uncertainty, citing ongoing global trade disputes and persistent geopolitical tensions as significant contributing factors. Mark Wall, chief economist for Europe at Deutsche Bank, provided an insightful perspective, questioning the immediate catalysts for a potential rate cut. He observed that despite the presence of U.S. tariffs and various other sources of global uncertainty, the European economy continues to demonstrate a capacity for incremental growth. This economic resilience, Wall suggests, is acting as a moderating force, keeping more dovish factions within the ECB in check and firmly anchoring the current policy pause. Looking ahead, the Bank of England is widely anticipated to hold its headline rate at 4% when its policymakers convene on November 6. In a separate development on Wednesday, the U.S. Federal Reserve opted to trim its benchmark rate by 0.25 percentage point, bringing it to a range of 3.75% to 4%, marking the second such reduction this year. The ECB's decision, therefore, places it in a context of diverging monetary policy approaches across major global economies, all while navigating the complex interplay of economic recovery and inflationary pressures. The focus now shifts to how the central bank will respond should these inflationary concerns intensify, or if the current economic momentum proves sufficiently robust to warrant a reassessment of its monetary strategy. The coming months will be crucial in discerning the ECB's path forward as it seeks to balance price stability with the imperative of supporting sustained economic growth in a world increasingly defined by unpredictable dynamics. The persistent concerns over services, food, and energy costs, coupled with the uneven inflation landscape across member states, present a delicate balancing act for policymakers aiming to foster confidence and predictability in the Eurozone's financial future.